Hi and welcome to Swissquote's Daily Market Talk. It's Monday, December 2nd. Europeans wake up to the new month with unpleasant news. The Japanese yen weakens on soft manufacturing PMI, while crude oil is better bid this morning on the back of a stronger than expected Chinese manufacturing PMI, and hope that OPEC Plus will delay or maybe even scrap its plans to restore production in the coming months. So December doesn't arrive with flowers and chocolates in its hands to Europe. On the contrary, the news on the wire this morning are all but magic, really. First, Stellantis CEO resigns on weaker sales and tumbling profits. Tesla and Chinese EV makers made a lot of progress indeed, while the European car makers actually missed the EV turn. The data from the Norwegian Road Federation is alarming indeed. It shows how fast Tesla and Toyota are increasing their market share, while German car makers like Volkswagen, for example, and BMW are losing ground. BMW's market share is now less than 5%, while 1 out of 5 cars sold in Norway today is a Tesla. And finally, the French political scene remains tense and messy, with the far-right Marine Le Pen threatening to team up with the leftists in France and take down Mr. Michel Barnier's government if he doesn't come up with a less strict budget plan by today. The problem is, France must reduce its budget deficit to meet the European Union's 3% threshold, and it is not necessarily on the right path right now, and there is no agreement that could make Marine Le Pen happy and the French deficit lower. As a result, the European futures are in the red at the time of filming this morning. The French yields will probably retrace last Thursday and Friday's decline unless magically someone comes and saves their French politics. And while the single currency is under pressure this Monday morning, the euro pound starts the new week with a move below the 83 cents level, and the euro dollar will likely test the 105 support very shortly and has potential to break the support to the downside on the back of an unsupportive political and economic setup that we see in the Eurozone countries today. One good news for France though, S&P reaffirmed its AA- debt rating if it's any comfort for anyone. That's it for Europe for now. In Japan, all the news are not brighter, mind you. Nissan CFO decided to step down as the company now expects its operating income for this fiscal year to be 70% lower than their previous forecast. So Nissan's share price obviously tells the story without using words. The share price is down by 65% since the November 2015 peak, and beyond Nissan, news are not great either, because released this morning, the Japanese manufacturing PMI fell to the lowest level since March this year, marking the 5th consecutive month of contraction on sustainably low new orders and also weak domestic and international demand. So the news gives the dollar yen a good reason to rebound back above the 150 psychological level this Monday morning, retracing a part of last week's gains that were triggered by the rising bets that the BOJ would hike the interest rates one more time before this year ends. Let's see if the BOJ is still up for hiking the rates this month. Now, the downside pressure on euro and on the Japanese yen is giving a boost to the US dollar early this morning. The US dollar index is up and above the 106 level this morning at the time I'm talking here, after retracing a part of its recent gains last week. Now, data-wise, last week printed a relatively strong 2.8% growth for the third quarter in the US, with a strong 3% growth in sales, remember. The data also showed that the price pressures last quarter declined, but the core PCE index in the US in October ticked higher from 2.7 to 2.8%. But happily, that was already priced in. So the picture painted by the latest economic data from the US last week doesn't necessarily call for another 25 base point cut in December. But this is what the markets are pricing in right now, because the US 2-year yield spent its last week sliding, while activity on Fed Funds futures gives around 68% chance for another 25 basis points in the FOMC's December meeting. Note, however, that the latter expectation could still change with a set of stronger than expected jobs and CPI data that are both due before the last FOMC decision of the year. So this week, the US will be revealing its November jobs data, and the expectations are quite mixed. Because the US economy is expected to have added around 200,000 new non-farm jobs last month, but that obviously comes after the meager 12,000 printed a month earlier due to the hurricanes, remember? So the unemployment rate, on the other hand, is expected to have deteriorated to 4.2% from 4.1% printed a month earlier, and the wages growth in the US may have slightly eased from 0.4 to 0.3% on a monthly basis. Now, given the hurricane disruption of the month before, the unemployment rate and the wages growth data will probably give us a more reliable information on the medium-term trends than the NFP number itself. So, the thinking goes, stronger than expected data will certainly revive the rate cut or not discussions for December, while soft numbers will boost appetite for another 25 base point cut from the Fed this month and could eventually limit the US dollar's upside potential this week. Now, in equities, last month and last year ended on a positive note for the major US indices, to say the least. The S&P 500 and the Dow Jones Index hit a fresh record high on Friday, while Nasdaq 100 also gained 0.90%. Then the small and medium caps consolidated near their all-time high levels as well. Whereas the European Stoxx 600 attempted a recovery on expectation that the European Central Bank will cut the roughly to give support to the struggling European economies and to eventually counter the US tariff threats, yet claiming fresh record highs for the European indices with such a long list of unfavorable factors sounds quite unreasonable to me, even less so as the European Central Bank rate cut bets are pressured by the recent uptick that we see in the European inflation numbers, and the US dollar's recent strength is not promising either. Though, note that some investors out there like the growing valuation gap between the American and the European stocks and bet that the things can only get better for the European stocks at the actual levels. Pick your side. I am personally a bit skeptical regarding the European stock markets. In the energy space, crude is better bid this morning, supported by better than expected Caixin manufacturing number from China, and also on hope that OPEC Plus will announce or maybe even scrap its plans to restore production next year to avoid adding to the global oil glut and pressuring the oil prices lower. So the barrel of US crude brings the buyers in below the $69 per barrel level, while Brent is bid below the $72 per barrel. OPEC could eventually give a positive spin to oil prices this week. Therefore, the short-term risks remain tilted to the upside until the December 5th OPEC announcement, but OPEC alone will hardly reverse the medium-term bearish pressures in oil prices if the demand side of the equation doesn't improve. Therefore, any price rallies in oil prices could be interesting top-selling opportunities later this week. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.